In the last few weeks, I've made offers 10 to 20% below list on 3 separate buyers in the $1 million price band. That's the band where my own data at NashvilleRealEstateData.com shows pending contracts are up 18% year over year. And the $2 million is now printing 53% year over year against the same week last year. The largest increase in demand we've ever seen for the luxury price bands. The K-shaped spread between under 500,000 and the 2 million has never been larger. In fact, we are seeing the first casualty of rising mortgage rates in the 300 to 500 single-family price band. It just went negative in demand year over year. Now, there's a major twist here. I'm going to get to that in a minute. I'm also going to give you a Nashville market update towards the end of this video. We're going to look at mortgage rates, active listings, and contract volume, how it could completely shift the dynamic towards the end of summer. But let's go back and talk about the 3 offers that I made and how the sellers reacted. One seller flat out rejected and said they got a much better offer. That one was listed for $1 million and we offered $800,000. So my guess is the much better offer was still much lower than list price. But this house also smelled like smoke. Don't you think that should be a required field in the property condition disclosure? Does it smell like smoke? Is it musty? Does it smell like pet? Put it in the comments below. Do you think smells should be a required disclosure? And by the way, this house isn't under contract yet. So whatever better offer they got, they still haven't worked it out. Now, maybe they will, but as the time of this recording, it's not under contract and it's been several days. So what happened with the other 2 offers? Big cuts. We came in more than $150,000 under the list price. This is 10%, more than 10% off, and they countered back and took a serious chunk off. Now, my buyer is still paying a very strong number relative to historical comps, but it's a popular and growing area, and the truth is, if they had cut the property $100,000 on day one, that house would have moved very quickly. So why the split? Why is the price band showing 18 to 50% growth in demand year over year, and yet 2 out of the 3 sellers are taking major haircuts? Even inside these price bands that are melting up when it comes to demand, the property either checks the buyer's boxes or it doesn't, and there is almost no middle ground anymore. The market is sorting properties faster and more ruthlessly than it has in years. Now, here's the irony and the twist of this whole thing. In the 500,000 range, where demand has been struggling to keep up, it has been very interest rate sensitive. Here's a text I got last night for a house in the $500,000 range. We put an offer on quick with a short deadline and unfortunately not short enough. Here's what he said. Man, it's been a wild day. The likelihood that my seller wakes up in Portugal tomorrow without 3 or 4 offers is very low. Now, I know you said if I got multiples, you didn't want to mess with it, so I just want to keep you in the loop, make sure that you're at least in the know. All the while, I talked to a builder who absolutely frustrated that he couldn't sell his $1.7 million house even when demand is up major double digits. So you have a $500,000 house in a market where demand is flat, and you have a $1.7 million house in a market where demand is up double digits, and yet the one that's in the demand is flat market is seeing multiple offers. If you were missing one thing, buyers have other options with more inventory coming on. I think there's real price corrections happening underneath the surface. It just doesn't show up in the median price or price per foot or even the home value indicator that Zillow has. Sellers are putting 5 to 10% of value add that will not show up in measurable ways, but absolutely shows up in buyer experience. My buyers are getting more concessions, they're getting more responses, they're getting more price discounts, and they're getting more during inspection. Now, you may be wondering where mortgage rates fit into all of this, right? The $500,000 house is going to be much more interest rate sensitive, whereas the $1, $2, $3 million house is going to be more sensitive to the direction of the stock market. Well, we see that mortgage rates are 6.65%, whereas last year they were over 7%. at this time. If mortgage rates stay flat, in other words, if they stay between 675 and 665, then by the end of June, we are going to start seeing a year-over-year negative in mortgage rates. In other words, mortgage rates will now be higher than they were last year. This will be a real headwind to interest rate sensitive groups in the lower price bands. That is a key thing I'm watching, and you will see demand, whereas it's still 7% higher in single family, we will likely see this demand go year over year lower by the end of July if rates stay where they are, simply because rates will then be higher than they were last year. With all the inflation pressures and rates being higher, I can't imagine us having higher demand July, August, September, given that rates are now year over year higher. Something to watch for. The other thing I'm watching for is active listings. They're now at 9232. Can they get over this high, this 2025 high of 9355? 9355, they only have 120 more listings to go, and they grew quite a bit last week, 150 listings. If they do that again, we are going to be at a new all-time high in active listings. I say all-time high, a new post-COVID high in inventory in Nashville. That is a key metric to watch. It's still growing steadily. It's growing slower than it did last year. We're only 6.7% up. But look, a 6.7% increase in active listings from the high of last year is going to put a strong negative pressure on prices, along with demand that could end up being down year over year in just 4 to 6 weeks. Something I'm looking for. It's a very interesting dynamic shift. And really all that needs to happen is all the trends need to stay in place. Active listings need to continue growing 6%, 7% year over year. Mortgage rates need to stay in the 6.75 range. If that happens, we will see contract volume start to trend much lower, and personally, I think it will be negative year over year in just a few short weeks. Something to keep an eye on. Now, remember, if you are a seller, you have 3 levers: price, presentation, and time. Those are your levers. If you want to move it quick, you have to cut your price. The data is clear. The outcome is not the same everywhere. Hyperlocal. Even in the bands that are surging in demand, sellers have to work harder. And with that, I hope you have a great weekend. Thank a veteran. Remember the sacrifice that they have made. It's Memorial Day weekend. That's what it's about. I look forward to seeing you next Saturday.